Welcome back. By the end of this video, you will learn what is a balanced scorecard and understand the 4 perspectives of a balanced scorecard. We will also discuss an example of a balanced scorecard in detail, which will help you understand how to use a balanced scorecard. As a bonus, I am also going to leave a link to a free balanced scorecard template in the video description, so make sure you check that out. The simplest way to describe a balanced scorecard is as a visual tool which is utilized to measure the effectiveness of an action, task, or initiative in relation to the strategic plans of an organization. Now, all organizations, if not most organizations, have a strategic plan in place, which consists of their vision, mission, goals, CSR, etc. Right? A balanced scorecard helps in breaking these down and successfully implementing an organization's strategy. Traditionally, most businesses only measure their success by comparing the financials of the organizations, things like costs, revenue, profit return on investment, etc. A balanced scorecard, though, aims to present a more balanced view by involving other perspectives of performance in addition to the financial aspects of the business. You can use the analogy of a person. So let's name this person Jim. He measures his success in life based on the wealth he has accumulated over the years, right? On the other hand, we have Sam, who measures the success of his life based on his wealth accumulated, the family he has raised, the friends he has gained, his own overall health, his contribution to society. Now, as we can understand from this example, Sam has a more balanced approach to determining success, whereas Jim's approach is more of a traditional approach, let's say, and is not comprehensive enough. Similarly, a balanced scorecard presents a balanced view that also takes into account other perspectives of success. Financial results inform us of what has happened in the past. However, it does not provide us any direction as to where the business should be headed in the future. And it was this very point of view which formed the main focus for the paper published in 1992 of the Harvard Business Review by Robert S. Kaplan and David P. Norton, who have been credited for the development of the balanced scorecard. In 1996, Kaplan and Norton released the Balanced Scorecard, Translating Strategy into Action. And Norton followed this up with another book titled The Balanced Scorecard, You Can't Drive a Car Solely Relying on a Rear-View Mirror. To summarize the second book by Norton, he used the analogy of a rear-view mirror in which he explained that when driving, you need to look forward, left, right, and at the rear-view mirror. He stated that many organizations, unfortunately, at that time, were trying to drive a car by only looking at the rear mirror and not forward. He stated that they need to pay attention to more than just the financials to be a successful organization. Think of the balanced scorecard as the dials and indicators in an airplane cockpit. For the complex task of navigating and flying an airplane, pilots need detailed information about many aspects of the flight. They need information on fuel, airspeed, altitude, bearing, destination, and other indicators that summarize the current and predict the future environment. Reliance on one instrument can be fatal. Similarly, the complexity of managing an organization today requires managers to be able to view performance in several areas simultaneously. The balanced scorecard suggests 4 perspectives which should be considered in order for any strategic plan to succeed. These are financial analysis, customer analysis, internal analysis, and learning and growth. The financial perspective traditionally deals with return on investments, growth, and costs. Under customer analysis, you should ideally spend time considering how your customers and other stakeholders perceive your business. How do your customers view your activities? What are the reviews and feedback? Do you have an objective measure of customer satisfaction from surveys or any other resources? If customers have a negative perception of your products or services, then this could hinder your growth as an organization and prevent you from achieving your strategic goal. Internal analysis, on the other hand, is a good way to find areas of your business that can be improved. For example, if some of your processes are time-consuming or too expensive, then you could identify those inefficiencies and try to fix them. Maybe something as small as changing up your hiring process can save you a lot more than you think. And finally, learning and growth examines the company's health in terms of training employees on rapidly changing technologies, monitoring junior employees in a way that helps them grow and contribute, and employing the latest tools and systems to foster innovation. To further understand this better, let's look at an example of a balanced scorecard for an e-commerce business. Now you will find various iterations of a balanced scorecard on the internet. Some of them are formatted like this in the form of a wheel, and then there are some just in the form of a table, which is what we will use today for this example. And remember, you will find a free link to download this template, both of them in the video description below. So this is what a balanced scorecard looks like. On one side we have the 4 perspectives, then we have 4 columns which are objectives, goals, indicators which are your performance indicators, and then initiatives or actions that we can take to make sure we achieve our goals, right? So let's begin with financial perspective. Let's say the objective here is to increase sales and reduce costs. Now the goal would have to be a SMART goal, right? So it has to be measurable. So 15% increase in net sales and 10% decrease in operating costs. That can be our goal, which is easily measurable. The indicator would be the financial statements of the organization, obviously. And then the initiative, what can we do to achieve this? Well, we can negotiate with suppliers. So that takes care of the financial perspective. Second is customer perspective. The objective here is to be a reference for a variety of products. Now the goal would be increase in launching new products every quarter by 15%. Right? Once again, this is measurable. We've given it a number, we've given it a value of 15%. The indicator for this would be number of new products launched per quarter. So ideally, we could check on the number of products we have launched each quarter if they are increased by 15%. Initiatives, how can we get there? Create an innovation and development committee, right? Assign some team members to this committee and assign them the task of achieving this objective. Next is the internal process perspective. The objective here is to be able to develop new products constantly. Goals again has to be measurable. Start at least 5 new product development projects every month. Once again, the indicator here would be the project innovation reports, which we could check that the development of at least 5 new products has begun every month. How are we going to do this? Acquire specific software for managing product development. Next, learning and growth perspective. Objective here is to have extremely knowledgeable staff in product development. Goals, have at least 2 professionals with master's degrees in product development. Once again, we have to give our goal a number and a value so we can measure it. Indicators over here would be number of product development professionals with master's degrees. Initiatives, select an employee to receive master's training and hire another with a master's degree. This way you're also creating engagement within your organization. And employee engagement leads to employee retention, which is a part of talent management. If you want to learn more about talent management, then I recommend watching this video next. If you found value in the video, then subscribe, like, comment and share. I post HR related videos every week. I will see you in the next video.